Welcome to Common Tax and Reporting Pitfalls to Avoid when doing business in New Zealand. I'm Rebecca Gans, and with me today I'm delighted to have Murray Serralius, a partner who specialises in overseas tax.
Hello Rebecca, and thank you for inviting me here today.
Pleasure. And also I have Anne Todd, who is a partner who focuses on audit and reporting matters.
Hi Rebecca, really good to be here today.
Excellent. So today we're going to cover common pitfalls and also penalties. So starting off, Murray, can I ask you some key fishhooks for businesses doing business in New Zealand?
Well, I guess starting off, whether you're coming to New Zealand for a one-off contract or establishing an ongoing business, it's important to understand the compliance obligations and the costs that you might incur, particularly around that tax area. And so it's vital that you set appropriate budgets and price contracts properly.
And what about if you're thinking about how long you're going to be here?
Well, if a business is operating in New Zealand for a short period, it may have fewer tax obligations. Typically 6 months is an important cut-off. After 6 months, there will be greater income tax liabilities and compliance obligations, both for the business and probably for employees as well. If you're in doubt about how long you're going to be here, then assume the worst and plan to be here, that you're going to be here for over 6 months.
And what if you do stay longer than 6 months unexpectedly and you hadn't planned ahead?
Well, depending on what you've done in the first 6 months, that might be where the nasty surprises arise. Typically, we see businesses that extend beyond the 6 months period unexpectedly suddenly find that they've got additional tax obligations, tax liabilities, and typically it's both for the business and for the employees. And what this means, we need to go to the Inland Revenue. Often it's a voluntary disclosure where we're trying to clean up the past and put people onto an appropriate footing.
Thanks for that. And Anne, if we move on to timing for financial reporting requirements.
Just listening into what Murray's saying about the importance of that 6 months time frame, you could use that from a financial reporting perspective to give you a headline as to when you should think about it. You've only got 10 days once you've established a permanent business here in New Zealand, so you might as well get on and do it.
Excellent. But what happens in terms of structuring those operations? What do you have to think about there, Anne?
There are many options for structuring your business. You can set up either a subsidiary or a branch, being the two most common, but you need to avoid surprises.
And what kind of surprises could you have with the branch structure? I hear those are quite significant.
That's right, and totally unexpected. You'd think registering your overseas company here as a branch would be the most simple, straightforward thing to do. In actual fact, what that ends up requiring is that you file your parent company accounts here in New Zealand as well as the New Zealand standalone branch accounts.
So a lot of extra work.
That's right.
Yeah, a lot of extra costs. And when it comes to actually filing with the company or the company's office, what is required there?
Those financial statements are filed, obviously. They have to comply with the International Financial Reporting Regime, but also you need to file an annual return. Now that's a simple online form, not a difficult thing to do at all, but if you've missed doing it, the company's registrar can just strike you off. They will assume that if you haven't filed that you're no longer doing business here, and that can give you unexpected problems.
So keep an eye on that timing, because otherwise it could be pretty scary.
That's right.
And those are the pitfalls for business. Murray, can you talk to us about the pitfalls for sending staff to New Zealand?
Sure. I mean, the first thing to think about with staff coming to New Zealand is whether they're going to have a personal tax liability or not, and factoring that into budgets and the contract pricing if that's appropriate. If the individual has a tax liability, then it's quite likely the business is going to have an obligation to withhold tax from their salary, and that means that the business is going to have to register here as well. It's important to plan ahead and to be aware of what the obligations are going to be.
And the timing factor, how does that work when it's thinking about employees?
Again, the timing is absolutely critical. An employee in New Zealand for less than 3 months will typically be exempt from tax. There's some hurdles to meet, but that's the normal outcome. If they're here for more than 6 months, then typically they're going to be taxable here, in fact almost invariably. That period between the 3 and the 6 months, that's where it gets tricky, and it very much depends on the individual circumstances. So it's important to plan the presence of your employees, understand how long they're going to be in New Zealand, and also take their personal circumstances into account. All of this impacts on both their tax liability and the obligations of the business.
And what happens if an employee is taxable and yet the business isn't?
Well, it's not uncommon for a business not to be taxable in New Zealand, but the employee to be here long enough that they are. If that happens, then we need to deal with the withholding tax, the PAYE, that has to be deducted from their salary. And the challenge is, if the business doesn't have to register in its own right, how do you do that? And there's a couple of options. The first is to do a shadow payroll. It's pay the employee off the foreign payroll still, but account for PAYE here in New Zealand. The other option is, in some circumstances, we can have the employee account for their own PAYE. And the advantage of that is that the employer doesn't have to actually register with the Inland Revenue at all. And this can be quite useful if, particularly dealing with multinational companies, where there's hurdles internally that they have to get over before they can register in a foreign tax jurisdiction.
Excellent. And then thinking about the staff themselves moving jurisdiction, what happens on staff pay equalisation? Any thoughts there?
Well, a lot of companies do use tax equalisation to take tax out of play for their employees, that the business takes the responsibility for the difference in tax between the New Zealand tax rates and the employees' home country taxes, and that means that the employees can actually focus on their day job and not get distracted with tax as an issue for moving around the world.
Great. So, I mean, we've covered off those pitfalls, but when you're actually looking after clients, Anne, typically do they come to you before or in the middle when they have already started?
Fortunately, most of them do come to us before they get started. That's the 80%. Those people then can manage their time and effort dealing with compliance issues really, really well. That 20% of clients that don't come early find themselves having to backtrack, and sometimes you can't go back. So you've got to deal with the structure that you're set up, and you can find yourselves having unintended consequences, like what we talked about before with the branches having to file their financial statements for their parent company.
And they can be significant, very significant. So, well, thank you for that. And let's look at the dark side, the penalties. How does that go on the tax front, Murray?
Well, tax penalties can get a bit scary. The New Zealand tax system relies on voluntary compliance and on self-assessment. So you get to make a decision about how to file your tax return. The Inland Revenue will come along later and tell you whether they agree or not. To help enforce that, there's then a range of penalties. So late payments, subject to a late payment penalty, 5% for the first month, and 1% for each month after that. There's also a use of money interest charge, which is really only meant to reflect the time value of money, but at 8.5% it feels a little bit hefty. And then from a shortfall penalties point of view, if the Inland Revenue has to make an adjustment to your tax return because it's incorrect, they will assess whether they think that there has been some culpable act. Have you lacked reasonable care? Have you deliberately evaded tax? And there's penalties imposed for that. They range from 20% at the lack of reasonable care end all the way through to 150% for deliberate evasion.
Yeah, so getting good advice, good idea, yes. So financial reporting, and how does it look from that perspective on the penalty front?
Right. On the one hand, conversely with the tax regime, the penalty for late filing is only $100, almost inconsequential. However, you can end up with an unintended consequence. The company's registrar may just remove you from the register, and in addition to that, your directors will have already been fined potentially $7,000 per director for late filing of financial statements.
And if they do strike you off the register, though, you have to get the lawyers to help you get reinstated, don't you?
It's not an easy process at all. In addition to that, very difficult to deal with your Inland Revenue issues if you're not actually a registered company on the register. So the consequences are quite wide-ranging.
Yes, they are. So thank you for that. That's it from us today. Thank you, Murray.
Thank you, Rebecca.
Thank you, Anne.
Thanks, Rebecca.